All right, hi, welcome back to DoubleLine Channel 11. Today we have a special guest with us, Gerard Minack. We've been a big fan of Gerard's work, going back almost more than a decade here at DoubleLine. And we got a lot going on in the markets with the Fed coming through yesterday with accelerated taper, maybe 3 hikes instead of 2, a little steepening of the curve this year. And many investors wondering what's to come. So I won't steal any of your thunder, and I'll turn it over to you, Gerard, to walk us through your thoughts for what next year may hold.
Yeah, thanks, Ken. Good to be on. I guess the first thing to say is my biggest disagreement with the market is the market doesn't think the pandemic's changed anything, whereas I think the pandemic is a major catalyst for a huge trend change, effectively bringing the curtain down on the secular stagnation era. And I think 2022 is the year that the market will start to appreciate that the secular trend has changed. Now, that's a huge call, and I've been a card-carrying secular stagnationist for longer than the phrase has been popularised. I used to tell everybody the world was turning Japanese. So let me start by just explaining why my view has changed on the big macro framework. And it really boils down to 2 things. First, the change of policymakers, and secondly, some signs that the outlook for capex is got structurally more bullish over the medium term. Let me share some charts. And I mean, the first part of the story, the policy change, is I think the pandemic really has been the catalyst for a shift from what has been for 3 decades monetary policy-led cycle management to one now where we're going to see fiscal policy take the lead. And that's hugely important because monetary policy was becoming increasingly ineffective because the neutral rate was falling so far, whereas fiscal policy works. And of course, what we saw in response to the pandemic was massive, unprecedented use of fiscal stimulus in peacetime. This slide shows the IMF's estimate of the fiscal spend. A lot of countries along that horizontal axis. The only 2 things I'd really highlight is, firstly, the difference between developed economies and emerging economies. On average, developed economies have spent over 15% on direct fiscal stimulus versus less than 5% for emerging markets. And then the bar on the far right is the US. The US is a world champion in terms of fiscal stimulus. Now, my view is once you've broken open the emergency case to use fiscal policy, we will continue to see it used in subsequent downturns. How can policymakers resist using a tool that has clearly worked? Now, that has meant that there's been a change in what the Fed's done in terms of supporting recovery. The Fed and other central banks have very much been taking a secondary role. Have a look at this slide, which I use to illustrate the difference now compared to how we behaved in the aftermath of the GFC. The blue line here is the change in the budget deficit, the US budget deficit, and the red line is the change in the Fed's purchase of treasuries. So the rise and fall of that red line in the aftermath of the GFC was the various iterations of quantitative easing. I've always thought quantitative easing was a relatively ineffectual macro stimulant. I think estimates such as the shadow Fed funds rate, which says that this sort of QE was the equivalent of a 2 or 3% rate cut, is frankly bonkers. I don't think there's any evidence to show that QE provides that sort of stimulus. That was occurring against a backdrop of fiscal restraint. And so the net impact of that combination was to dampen growth. Well, look how different this time's been. We've seen massive fiscal stimulus backstopped by massive Fed buying. This is as close as you get to debt monetisation. Yes, we didn't see the Fed deliberately or directly drop bags of cash at the Treasury door, The whole transaction got laundered by a brief period of private sector ownership of those treasuries, but this is really money printing in every way. But the active ingredient here is the fiscal. We know what money printing without fiscal does. That's the post-GFC scenario. So this is a very, very powerful policy tool. And although this chart focuses on the US, the fact is every major central bank in the world has been doing the same thing. This is showing you the size of central bank balance sheets relative to their own economies. And on this scale, the US has been relatively restrained. There's a second big change in policy that I think is affecting the trend outlook for growth. And that is what the Fed's doing and other central banks. No one should rely on fiscal policy to provide restraint in the upcoming expansion. So we're going to have a situation where stimulus is coming from fiscal, but restraint will come from central banks. So here, the second important change is that central banks, firstly, are no longer focused solely on inflation. Most of them have also now focused on labour market conditions. And secondly, and I'd argue most importantly, they are no longer preemptive. What we've seen over the last 3 decades is central banks trying to move policy ahead of inflation trends to keep inflation in check. Now, as it turned out, they weren't very good at that. We kept on undershooting inflation. So now we're seeing a sea change in how they tighten policy. And the best chart, I think, to see how that's changed, particularly in the US, is this one. When the Fed was setting monetary policy preemptively, that effectively meant it was synchronising the rate cycle to the wage cycle. Now we have wage growth running at levels not seen in 3 decades, and the Fed still is at zero. So this is a huge transformation in the operation of monetary and fiscal policy, and I think it means that we're likely to see economies running hotter over the next 2 or 3 decades.
I've used this chart very recently, and I joked that every time it seems like the average person on the street is about to make more money, the Fed hikes and kills the economy and doesn't let them get ahead. And I guess
Correct.
One of the things
that's how it boiled down, and that's this is tied up to their objective to have full employment, fully inclusive employment, and it also means that this could be a cycle where Main Street does a lot better than Wall Street, which I'd argue has been flipped on its head over the last couple of cycles, where Wall Street made out like bandits, and as soon as Main Street started to get a slice of the action, the Fed took away the punch bowl. So this is a changed world in my view. But the other point about the change in the secular trend is really some of the other forces that I think are going to weaken secular stagnation. Now, secular stagnation is really a story where planned saving tends to exceed planned investment. This chart shows investment spending in the US relative to GDP. It's been on a trend decline for many decades. There's a lot of factors behind why this decline occurred, and I think some of them are starting to reverse. One of them was globalisation. This chart shows investment spending in the developed economies and emerging economies. Part of the reason we saw this wedge open up over the last 2 decades was some of the investment that would ordinarily have been done in developed economies got subcontracted to the emerging world. I'm not implying that this gap will narrow completely, but with some onshoring, bringing supply chains back to developed economies, a shift from just in time to just in case style production means I think we will see some narrowing in this gap. The second reason to expect investment spending to rise, and I'm not happy about this one though, is I think defence spending is going to start to rise as a share of GDP. We saw, the defence spending fall particularly sharply after the Cold War ended, the so-called defence dividend. I think we're now seeing a rights issue, and this will tend to trend higher. A third factor is spending on climate mitigation. This slide shows an estimate from the International Energy Agency of the investment needed to be made globally if we were going to reach net zero by 2050. Around $5 trillion a year That compares to global GDP that is now under $100 trillion US dollars. So we're talking about 5% of global GDP for climate mitigation. We're also seeing in a number of places a pickup in public sector infrastructure spending, which probably is overdue. This slide shows in blue public infrastructure spending in the US. It's at post-war lows, and that decline has been associated with a huge increase in the ageing of the public sector stock. So this is one of the few areas of bipartisanship in the US, obviously, to increase infrastructure spending. The final point is, I think if we run labour markets hotter, the incentive to do labour reducing capex goes up. So there's been a fairly strong correlation between labour costs and capital per worker. The labour cost leads this series by a year or so. So if we do get wages and labour costs rising, I think that will encourage corporate capex to pick up. So the bottom line here for me is I think we are on the cusp of a trend break in what we've been used to for the last really 2 decades. And as a consequence, I think we're going to see rates go higher in this cycle than markets expect. And markets are mistaken in believing that the pandemic was a short-lived thing and conditions will revert to the sort of soggy cycle that we saw in the aftermath of the GFC.
Yeah, I mean, surely as you look at the long end of the interest rate curve, the long end, at least till maybe very recently, even a day or so ago, has been falling. We've seen a big flattening, kind of sending a signal to the market that it doesn't believe that there's going to be long-term inflation. It doesn't believe that there's going to be long-term growth. Just like the past couple hiking cycles, the Fed's going to raise rates. It's going to slow the economy down, and we've seen that long end fall. And I think it's, to your point, it's believing that we're going back to that post-global financial crisis era of the sweet spot for equities, low growth, low inflation, accommodative policy.
Ken, I couldn't agree more. And the funny thing is, all throughout this year, every client meeting has been a debate about the inflation outlook. It's been the hot topic. But when I look at my Bloomberg screen, there is no debate. Mr. Market has put all these chips on the inflation is transitory view. In other words, that this will quite quickly blow over and we revert to the post-GFC style sogginess. And there's many ways to show this. I mean, the most obvious is, I guess, if anybody thought 5% core CPI was really going to hang around, it would be inconceivable that 10-year bond yields would still be under 1.5%, or indeed that Wall Street would be on the valuations it's on. But let me show you a couple of more slides. And I'm going to start by showing you 2 market forecasts. And as I say to people, I think it's almost impossible to believe that both these forecasts will be right. One of them may be, or none of them may be, but it's hard to believe that both of them will be. So let's start off with a very clean read on what the market's expecting for US inflation. And we get that by looking at the inflation swaps. Now, these settle on headline CPI. Headline CPI tends to be a little above the PCE deflator, which is what the Fed actually targets. So that green line in this chart really implies that we're on a fairly quick glide path back to the sort of inflation that the Fed is targeting. So absolutely, that this is a transitory inflation problem. Now let's have a look at what interest rate markets are pricing for the Fed. The Fed obviously just recently updated its dot plots. The red line is just the short rate futures and what they're saying. So they're now equivalently hawkish for next year. But the really key point in my mind is that the market is saying the Fed will not need to lift the Fed fund target much over 1.5%. Now, just put those 2 forecasts together. What the market is saying is that the Fed will not need to lift the real inflation-adjusted Fed fund rate much above -1% to control inflation. Now, my view is either inflation is not brought under control fast because the Fed is too slow, or if inflation is brought under control, the Fed's going to need to be a lot more aggressive than what rate markets are saying. Now, let me show you another way to look at how the market really hasn't changed its view of the framework despite the shock of the pandemic. This slide shows or focuses on the market's expectations for the policy rate. The blue line is the average real Fed fund rate expected over the next decade. The red line is the real Fed fund rate expected at the end of the decade. So the blue line is the decade average. The red line is the end of decade, which I'm going to assume is the terminal rate, because I doubt that the market's got a strong view on where in the cycle exactly we will be in 10 years' time. Now, what's remarkable about this is if you go all the way back to the GFC and its immediate aftermath, although that was a very deep downturn, the market at that stage was saying nothing's really changed. Although this was a deep downturn, the Fed's going to need to maintain, on average, a real Fed fund rate of 1 to 1.5% over the coming decade. And at the end of the decade, we will have a real Fed fund rate back at 2 or 2.5%. So very much the same rate framework that the market had pre-GFC. So once again, here's another example where the market didn't realise that something had changed. It really took the Euro crisis and also austerity in America to drop that blue line down. So all of a sudden, markets went, we can't go back fast to the rates that we had pre-GFC. So this was really when the market embraced the lower for longer idea. But even then, the red line remained above the horizontal axis. So there was always some light at the end of the tunnel. Well, guess what? In the pandemic, even that light got snuffed out. And we moved, as I say to people, from a lower for longer framework to now a lower forever framework. This is daily data. This is updated to yesterday's close. There's been no change. In other words, the market has, in a funny way, turned even more dovish on rates now than it was at even the worst point of the post-GFC cycle. And another way, the final way, just to reinforce this point, is to look at a long history of the real Fed fund rate. And, you know, we've seen the growing power of the forces of secular stagnation over the last 2 or 3 decades. What that has led to is this succession of lower peaks in the real Fed fund rate. What the market is effectively saying is that we're going to make a new lower low. Nothing's changed. The forces of secular stagnation have intensified. And I just think that is a huge, huge mistake. And the story of the next few years is the markets, in my view, realising that they have mispriced that outlook.
Yeah, I mean, it definitely seems as though a lot of complacency, and maybe it's just a recency bias of having lived over the last decade plus in this continuous low growth environment. As we think about inflation, you had a good piece that I've used with investors, and that's that we did see that big spike in core goods inflation created by the stimulus checks, increase in demand, and QE doesn't. And fiscal doesn't increase the supply of cars and goods. And, I think everyone acknowledges that shelter is probably heading up higher for a little bit at least. So I guess if you could nail wages, which drives services inflation, that's kind of the key. And I'm kind of in your camp. It seems like the Fed's going to let things run a little bit hotter for a while. And I also look at the demographics. And Powell mentioned it yesterday in his testimony that there's a lot of people that may not come back to the workforce. There's a big demographic shift of the baby boomers that are leaving now. And I think that's going to keep putting pressure on wages. Of course, the Japanization concept says that that's actually going to lead to lower inflation with less spending. But I'd argue Americans aren't Japanese, and we have a little bit different spending behavior here.
Yeah, no, for right. I mean, I think the demographics will be a factor in the US, but my point would be the main way demographics affects inflation is by, as workforce growth slows the demand for capex slows, which is something that you've already seen in the US, just like we've seen in Japan. So that's why it's so important that there are now these almost exogenous reasons for why capex may start to rise, because it can absolutely counteract the ordinary tendency of an aging population to do less investment. But let's drill down on the inflation story, because this is obviously going to be crucial. And look, I think we're seeing two waves of inflation in this cycle. The first wave, which I guess is transitory, is due to the shock of the pandemic. And this chart shows, I guess, one of the many unusual features of this pandemic downturn. It just shows global PMIs. The blue line is the delivery time index. And when the blue line is low on the slide, delivery times are fast. So in a typical recession, delivery times speed up because there's spare capacity. But in this downturn, the blue line spiked, and now the series is near its all-time highs. So we all know about the supply side shortages. What that meant was, to a very unusual degree, we saw factory level inflation flow through to consumer level inflation. And if you think, well, doesn't that always happen? The answer is no, it doesn't normally happen. This slide just shows the price level of core goods in the US. There's been this wedge opening up for 2 decades between factory level prices and consumer level prices for core goods. But you can also see, obviously, core goods prices up over the last 18 months. They've increased more in the last 18 months than they have in the prior 2 decades. That's how unusual this has been. What made this time different? Well, the supply shortages meant that we simply ran out of stuff to sell. This shows inventory to sales ratios at all-time lows, and that gave good sellers what I think is a transitory bout of pricing power. So that's what everybody agrees with. The real key to inflation going forward, however, is going to be shelter and services. This chart just shows a 3-way split on core CPI. You can see how unusual that large contribution from goods prices are. But normally core is simply a matter of shelter and services. And it's not just that it's a matter of shelter and services, it's these things don't tend to bounce around. If we start to see inflation being pushed up by shelter and services, it will be impossible to dismiss that as transitory. And I think that's going to start to be the story of next year. So a quick couple of slides on these things. Rent are already starting to rise. The blue line here. Landlords are asking more, which is the red line. Landlords don't always get what they ask for, but they certainly point the direction of travel. But what's interesting for me is I think the single most influential factor for rents is not house prices. In fact, if you look at the 2000s, that cycle when house prices boomed, rents did not. The post-GFC cycle when house prices busted, rents were the largest single contributor to inflation. So what's going on? Well, the single biggest influence on how much a landlord can charge is how much his or her tenants get paid. So there's a historically tight correlation between wages and rent. The post-GFC cycle was a little different because of the housing bust, and a lot of people were evicted, so that put an unusual rocket under rents. But absolutely, if wages stay strong, I think rents will also stay strong. And services, it's just a matter of labour costs also. No secret there, very labour intensive. So for me, wages absolutely drive the core CPI. And as already noted, we've got wage growth now at the highest level in several decades. The outlook, let's have a look at an old-fashioned Phillips curve. This chart's just showing the relationship between unemployment on the horizontal and labour costs on the vertical. And the way I've sort of framed this for my clients is how much inflation pressure you'll see will, in a sense, depend on whether the Phillips curve has moved again. If we're still on the post-GFC Phillips curve, which is the purple line in that slide, the US could probably push unemployment to 3%. and have wage growth consistent with the Fed's inflation target. If, on the other hand, the US has reverted to the pre-GFC Phillips curve, which is the blue line in this slide, then 4.5% unemployment is probably the level that starts to generate inflation pressures that are going to unsettle the Fed. Well, where are we? Never put too much weight on data for a quarter, but where we are today suggests that we could be on a new, even higher Phillips curve. Now, I'm not saying we absolutely will be on a new higher Phillips curve, but I think the next 3 to 6 months will be absolutely crucial. If we see a reluctance of the participation rate to go back to where it was pre-pandemic, it would point to a new higher Phillips curve coming into view. And that would suggest we've already got unemployment at levels that are inconsistent with the Fed hitting its inflation target over the medium term. So watch this space. I think it's going to be hugely important. But I'd also argue that although some of those transient inflation pressures will reverse, we could easily see markets become more unsettled by inflation next year, even if core inflation is lower. Go back to this slide. Now, here we are with 5% core inflation, and no one seems to care about it. And by no one, I mean bond yields under 1.5%, 10-year notes under 1.5%, and Wall Street on a PE 25. What happens if next year we end up having core inflation at 3%, so lower than now, but that 3% core inflation is a reflection of goods prices that are now subtracting 1% from core, and the shelter and services contributing 4 percentage points. So we've got a lower core inflation rate, but my bet is the markets will be a lot less comfortable with that, because just as I'm looking through the contribution to goods prices now as being transient, one would imagine this time next year they would look through any drag or dampening effect of goods prices as likewise transient, and they'd be focused on that shelter and services component, which I think is only going to head one way next year, and that is up. And that's the problem I think that we could start to see emerge for markets next year.
Yeah, we have a mix of deflationists and inflationists at DoubleLine, as I'm sure there are at many firms, and forever and ever and ever, we've been watching wages and saying, well, that's what's kept inflation down, is the slack in the labor market for the decade post-global financial crisis. And now wages are finally on the rise, and the deflationists are saying, well, it's temporary because people are going to come back in the workforce. I guess that's one of the things that we debate here. What's your take on that as far as labor participation?
I suspect it'll drift a little higher, but if you look at the composition now, there's been no budging at all in the over 55 participation rate, which dropped immediately as the pandemic hit, and there's not been any improvement at all. So one would think that they've probably left the workforce for good. There's also been a drop in female participation in the sort of 30s and 40s. Now that may come back, but even there, I'm less confident today than I would have been a quarter ago, because the view had been that the reason for the drop in participation there, females of child-rearing age, is the difficulty in having childminding. But as schools have gone back, that excuse is starting to wear a little thin. So I think the odds are mounting that we are going to see a massive return of labour supply. But the really decisive point is the Fed has not responded to wage pressure like it has in prior cycles. And I don't think this is a cycle that's going to spontaneously combust, which, when I debate this with people, the people that push back against my view that effectively interest rates will have to go a lot higher than the market's pricing, they're arguing that things will soften quite quickly next year, that we've seen some sort of sugar hit that's going to reverse. That's a story I strongly disagree with. I think it's people misunderstanding how, in particular, fiscal policy has worked, And, there is a school of thought out there, and there's some well-known sell-side economists out there talking about fiscal slowing growth quite quickly. I think that's wrong, and that's going to be as much as a shock to people as participation not bouncing back quickly to pre-pandemic levels. Let me just show you some slides on that.
I've heard that argument myself. It's the stimulus checks created a one-time buying spree, which could fade, right?
Yes. Now, the point to note there is, the government set the checks in large part because it stopped people working. And so this chart shows in red total household disposable income. The blue line is income ex government transfers. So obviously the gap in between is what the government transferred. So we get the income drop from non-government sources. The government tops that up. It actually tops it up more generously. But a lot of that got saved. So it's wrong to say that all those transfer payments got spent. It didn't. Everywhere you look around the world, the household sector is sitting on an unusual pile of cash, which is unspent checks from governments. What we've now seen is non-government income effectively go very close to back to trend, the pre-pandemic trend, and disposable income almost go back to pre-pandemic trend. So in other words, the government could withdraw its stimulus without creating any headwinds on the economy because it was matched by private sector income going back to where it was pre-pandemic. Now, people are going to talk a lot as we head into next year about the so-called fiscal impulse, which is the change in the budget balance, which is what ostensibly delivers fiscal stimulus or fiscal tightening. And the way I've done it here on this slide, when the bars are low, it's stimulus. When the bar is high, it's restraint. And these are Congressional Budget Office numbers as well as forecasts. And yes, it looks like next year, that's the high blue bar. We're going to see virtually an unprecedented degree of fiscal restraint. Well, as I said, it's misleading to look at the raw number because a lot of the stimulus was not spent. So to withdraw stimulus that wasn't spent will never offer restraint. But there's an even more compelling reason to think that this analysis hugely exaggerates the likely impact of fiscal tightening. And the answer is very simply, we've already seen the worst of the fiscal tightening. This is all calendar year average numbers. Let's have a look at the quarterly numbers. The quarterly numbers, I suspect, in terms of the adverse impact, has already peaked. In the September quarter, the federal budget deficit was 8 percentage points of GDP lower than it was in the September quarter a year earlier. And in the June quarter, the tightening was 14% of GDP. So we've coped with what appears to be enormous and unprecedented fiscal restraint. And the reason we could cope with it was most of the checks weren't spent and the income that was lost through the lockdowns has now been replenished. And that means if you actually look at household income, core household income, which for me is wage growth, because for the average American, they don't get dividend checks, they don't receive a lot of interest income. Wages is their bread and butter. In the year to the September quarter, real payments to labour, were running 6 percentage points above year earlier levels. Now, that's huge support for your average American. And I don't think there's anything really to worry about fiscal tightening. We've seen it, we've coped with it. This is a cycle now that's got, I think, powerful momentum as we head into 2022.
So going to be decent growth coming, inflation, higher nominal yields. And so what does that portray for risk assets? I think is probably where you're going to go next, right?
Correct. I mean, look, the issue is I don't think this is going to be a terrific environment for low yield and no yield assets. And clearly, I think fixed income is going to be a poor place to be. And ultimately, I think and when I say ultimately, that means this is not a story for 2022. I think we'll get the Fed fund rate with a 3 handle, and I think we'll get 10-year Treasury yield up around 4%. And that will really solidify this view of mine that we're bringing the curtain down on secular stagnation, because what we've seen for 4 decades is a pattern of lower lows, lower highs. If we ultimately see a 4% 10-year yield, that will break that pattern, given that we saw the last cycle peak for the 10 years, which was as recently as 2018, was 3.5. Now that sets up a challenge for, as I said, low yield, no yield assets. It doesn't mean necessarily a huge bear market for equities. The equity market story, I think, is actually quite nuanced. And let me take you through some slides. The first thing to say, just for asset allocators out there, even when the Fed is tightening, it normally still pays to be overweight equities versus treasuries. This slide shows a long history of the relative performance of US equities versus treasuries, both on a total return basis. The shading in this slide are actually when the Fed is tightening, not NBER recessions. So the red line normally rises through the shaded zones. What really kills equities versus bonds is not Fed tightening, it's Fed easing. And obviously that's correlation, not causation. What really causes pain for equities is recessions, and that's also why the Fed eases. So I think bonds are going to do poorly. I think equities are going to do poorly, low returns, but not quite as bad as bonds. But a 60-40 portfolio next year, I don't think it's going to have terrific returns. And the reason equities tend to give lower returns is they almost always derate when the Fed is tightening. This chart just shows the prospective PE on S&P 500. The shading, once again, is tightening, and you can see normally we see derating. Of course, there is also earnings growth going on, so you don't need bear markets to accomplish derating. But I really think the story for many investors is going to be one level below the asset class level, particularly for equities. I think the big story is going to be a change in equity leadership. And this gets back to a point I've already mentioned several times, which is, for now, the market is seemingly skeptical about the strength and sustainability of the expansion. And I think next year is when it starts to realise that perhaps things are a little bit better than we thought. There's lots of ways to show that. One simple way is to look at the relationship, for example, between commodities and commodity currencies. Both bounced off the pandemic lows, but commodities, up until just very recently, continued to rise, whereas commodity currencies have been rolling over for the last 6 months. Another way to look at it is sector performance in global equities. This slide just shows the year-to-date return in global equities up until mid-May, which was just before the bond yield started to fall. This is an absolute pro forma example of a cycle or an equity market that is buying reflation. The best performing sectors are your classic cyclicals: energy, financials, materials, industrials. Bang, this is textbook stuff. Yeah. But look what's happened since May. The biggest performers have been tech, consumer discretionary, and most of the cyclical sectors have lagged badly. Now, what's remarkable about this is then compare it to what earnings forecasts have been doing. Now, this slide shows the 3-month change to year-ahead consensus EPS forecast. Energy off the scale. But the biggest upgrades have been industrials and financials. The biggest downgrade is consumer discretionary, one of the huge outperformers of the last 6 months. In other words, the equity market has been ignoring the story of the earnings tape. So let me show you one more example of this, 2 more examples, sorry. This is looking at the relative valuation on cyclicals, global cyclicals versus defensives. Equity markets do look ahead. So this tends to lead the developed market manufacturing PMI. The recent derating of cyclicals, which is because they've had earnings upgrades but have actually underperformed, is consistent with the cycle rolling over, going back to a global PMI near the boom-bust threshold of 50. The market has put its chips on quite a severe slowdown next year. Finally, let's have a look at what the high beta goods producers are doing. Now, this slide, let me explain. The blue line is the earnings expected for the global goods producers relative to the overall index. The red line is the performance of those goods producers relative to the overall index. And as you can see, over a run of years, relative performance is driven by relative earnings. Who would have thunk? But now have a look at what's been happening in the post-pandemic period. The earnings forecasts for the goods producers have been skyrocketing relative to the rest of the market. Initially, the red line joined in. We saw these goods producers outperform, but 6 months ago, they started to roll over, even though the earnings story continued to work in their favour. The market simply ignored what was going on. Now, this has got a precedent. If you look back at the top and then the pop in the TMT bubble in the late 90s, we saw a very similar phenomenon. The goods producers started to get relative upgrades. The market ignored it until the damn wall burst. The market had to realise its error, and we saw a bounce in these high beta sectors outperforming what had been last cycle's leaders. So I think we're at one of those funny turning points. I think the big story in equities next year will not necessarily be one of massive boom or bust in the overall index, but I do think we're likely to see a change in leadership from what has been the winners of the post-GFC cycle to what I think will be the beneficiaries of a cycle that will be stronger for longer.
Yeah, it was a big theme coming into 2021. Value finally outperforming, as you've noted. It worked for a while, and then once, I guess, the market stopped believing in growth and thinking about turning over, rates fell down, and voila, all the high flyers took off again, right? As the market seeked out growth in a world of no growth.
Yeah, there's even another parallel here with what we saw back in the late 90s, early 2000. The NASDAQ peaked in March 2000. If you focus simply on that, you miss a story of what was happening beneath the surface. Even in late 1999, the most speculative, one could say egregious parts of the bubble started to pop. So this was the pets.com of the market. They actually declined quite sharply through the latter months of calendar 1999. What that then prompted was not the overall tech bubble popping, but we saw a rush to quality tech. And back then, this was stocks like Microsoft and Dell and Cisco. So the last surge in the NASDAQ was led by those quality names, and the breadth of the market actually narrowed quite dramatically.
You're seeing that right now again. If you look at the NASDAQ, the stocks below the 200-day moving average continues to climb, right?
Correct. And what we've seen, if you look at the tech stocks that have got no earnings, they're already in quite a severe bear market. And once again, people have not left tech. What they've leapt on is a narrowing group of leadership stocks that have pushed the NASDAQ up. Now, ultimately, I think those leadership stocks, although they're quality names, but they've re-rated to the point now where any lift in bond yields, I think, will see a penalty in a valuation sense. And I go back once again to the analogue of what happened as the tech bubble in the late 90s topped and popped. Microsoft, great company. No one has any issues with how it was run. It took 15 years before it got back to its 2000 peak, even though it kept on generating earnings. In other words, it had got to a valuation level where it took several years for earnings to grow into the share price. And so even good companies at the wrong price can be poor investments. And I can see quite a few parallels with how the market is behaving now compared to how we saw it behave in the late 90s, early noughties.
So we talked about rates, we talked about stocks. What's your view on commodities and gold in an environment of inflation?
Look, I think commodities, industrial commodities, there's an uneven outlook, but net, I'm upbeat. I'm upbeat partly because I still think the demand for stuff, for goods, is going to remain strong. And that gets back to those slides I showed about the demand for climate mitigation, defence, infrastructure. These are all things that pull on hard, tangible stuff, and all you need industrial commodities. There will be some unevenness there. Obviously, a couple of commodities that are close to my heart as an Australian is the bulks. They are very dependent on the performance in China. So they may not go so well because I think Chinese trend growth is slowing quite significantly. Gold is the real puzzle for me. Full disclosure, I hold gold and gold stocks. Unfortunately, if I'm right, and next year could see no yield, low yield assets struggle, then that would ordinarily make you think that gold could also struggle. Where I see a glimmer of hope for gold, however, is I think some of the natural buying for people looking to hedge inflation risk has been diverted to Bitcoin and crypto generally, whereas I think that's really going to struggle next year. Crypto is quite highly correlated to risk-on trades. If next year becomes a bit of risk-off, I think crypto suffers, and that may see some money flow back into gold. So I'm cautious of being too bullish on gold, but I'm not selling my holdings. That's all I'll say. And I still think it's worth holding gold as a diversifying asset in a balanced portfolio.
Well, you already got to crypto, which was going to be my next question. So I guess my last question will be the U.S. dollar in a world of higher Fed funds rates than I think the market expects and higher long-term yields. Does that bode positively for the dollar then?
I think it does bode positively for the dollar. The one thing I would say is I think currencies really over the last 10 years have been driven as much by relative growth rates as relative interest rates. And I can see further dollar upside in the next 6 months. I think what we start to see second half of next year is the growth gap between the US and other developed economies starts to narrow, and I think that may cap out the dollar. But look, I don't want to be either characterised as a big dollar bull or bear. I honestly believe the dollar is going to stay in the range that's really been in through the last 5 or 6 years. If you look at, say, the Fed's narrow trade weighted index, which is really the dollar against G10, it's been range trading. By the middle of last year, it was at the bottom of the range, so it made sense that the next move would be up. But I don't think we're starting a multi-year dollar bull market.
So if the dollar goes sideways or even slightly weakens, one of the pockets of that has lagged is emerging market equities. My final question for you is, what are your thoughts on emerging market equities?
I think it's an uneven outlook. I tend to start whenever I talk about EM, just dividing the world into China and the rest. And that's been absolutely even more pertinent now when you've had these idiosyncratic measures coming out of China, which obviously has damaged sentiment there. So I think China's got some problems, not just in policy making, but also the underlying economics. So I'm a little leery of taking any investment position in China. The rest of EM, I think, will also play catch up with the US next year. That's partly because either by vaccinating or being infected, their immunity will improve. I think they'll participate in this global demand for capex. And from an equity perspective, they look relatively cheap. In fact, the simple point is non-US markets look relatively cheap compared to the US. Valuation is never a reason by itself to buy a market, but what I think you'll see next year with the growth gap between the US and the rest of the world narrowing, that's the catalyst you need to see some of that more attractive valuation be realised. And so I think non-China EM, and I think my favourite market is Japan, followed by Europe, should all outperform the US next year. It may be a mediocre year for equities overall, but that may end up being, a small down for US equity markets and, high single-digit gains in US dollar terms for non-US markets. That seems roughly what's fair.
Yeah, and Japan and Europe are very heavy in some of the sectors you think will do better, like industrials, financials, right? Correct.
No, look, I think you can either play this tilt at the regional area. I think the cleaner way to do it is at the sector area. So if you're going to be overweight financials and industrials, that almost inevitably makes you overweight Europe and Japan, which I'm quite happy to be. I think we're moving from a decade where we had slow growth and anemic earnings. So the ability to grow earnings was very scarce in the both post-GFC world. So if you had that ability, given its scarcity, you got re-rated. If we're moving to a cycle that's going to be stronger for longer, the ability to grow earnings will not be scarce. It'll be quite common. So what people should look for is companies that have operational leverage. That is, can milk the cycle for the earnings upside. And that's quite a different cohort of companies to what were the relative winners in the post-GFC world.
Makes a lot of sense. Well, Gerard, thanks so much for making time early over in Australia. For everyone that's watching this, if you're interested, Minack Advisors, please reach out to them for information about their research. Big fans of you here at DoubleLine, and we look to see you in person, hopefully one day in the near future.
Thanks, Ken. Thanks for having me. Have a great break, and yeah, he's hoping 2022 gets a little bit back towards normal. It'd be great to catch up in the US.
All right. Thanks so much. Have a great day.